Welcome back to another episode of the Backholder Pod. So I think for Eric, he has some personal issues, some personal emergency. So we'll proceed on without him. So I think specifically today, we'll be talking about Singapore banks. I think it's kind of an extension from the previous episode where we were talking about dividend investing and specifically REIT investing. So I think for banks, it also probably comes under the portfolio of companies that many Singaporeans do follow. So I think specifically, recently, I think all the three major local banks have just reported their earnings, and we are just gonna give a sneak peek and maybe provide our opinions on essentially the banking industry. So I'll pass the time over to Kelvin. He will share with us more details around the overall banking earnings.
So this is the business types lah. Today they summarized all the earnings in one table, sweet for us. Is, as you can see, net interest income for DBS and OCBC was the highest, 40% increase year-over-year, which was quite impressive lah. Then the net profit is very good also. But you see that the gross loans start to drop. I guess people stop taking up loan during this period. Like I think it's near to like 4%, but it's not 4%. I think slightly lower a bit. So people are taking less loans now. And you will see that customer deposits. The interesting thing is that DBS never really increased. But for OCBC, it increased by like 5%. That's because if you look at the DBS multiplier versus the OCBC and UOB, DBS didn't really increase their interest rate for the savings account. But OCBC and UOB was like aggressively raising their interest rate. Right now it's like 3.85%, while DBS, if you use the exact same criteria, it's only like at most 2% around there. So DBS, I guess they didn't see the need to compete in that area. So that's why the customer deposits didn't increase by that much. Net interest margin, yeah, the rest nothing special. Earnings per share, DBS is the highest. So like I said, they didn't need to compete in that area because elsewhere they're earning more. Net profit, yeah, elsewhere they're earning more. Price to book, DBS is the most expensive one. Because their growth rate, these two growth rate I got from Yahoo. The growth rate is the highest. Next 5 years, DBS is estimated to have the highest growth as compared to OCBC and UOB. That's why their price to book is a lot higher. Dividend yield, as expected, higher price means lower dividend yield.
Hey, thanks for the great summary actually, because I think personally I haven't really been following Singapore banks as well. So maybe open to the floor, Bunti. You have any? Don't stop sharing screen. I think maybe Bunti want to.
So my first question is, I know there are some people who say avoid investing STI because all these banks, right, which constitute quite a large proportions inside STI, they say they are not innovative. They don't do much to like build their moat and so on. And then there are some people who say actually DBS is very innovative. So I just want to get a sense from both of you. Do you think that our local Singapore banks, right, are they, do they actually spend enough money to in their innovations or not? Or do you think that they are like dinosaurs waiting to be disrupted?
This is from personal experience. So now I think from an investor's perspective, I'm still trying to figure out like what exactly is the modes of the different companies. Because it does seem like, at least for the younger folks, because they have different target audience. So let's talk about the younger folks, right? It seems like people are getting much more savvy in terms of moving their money and funds. And there really isn't this level of loyalty compared to other older folks. So I think if you want to make the argument that, hey, DBS, OCBC and UOB has very strong brand equity, people are willing to park millions of dollars, assuming that all the rich people, because they don't need to scared that DBS go under, because I think all three are kind of government linked in certain ways. But then when you talk about like your smaller up and coming digital banks, right? Like GXS, for example, they are giving great amount of interest rate, up to 75k or something like that. The younger folks will start moving their money over to GXS because there is no sort of loyalty. Oh, I must only put money with DBS. I think people want to diversify the amount of the pot of money. But that being said, I think if you really talk about like amounts over the insurance threshold, a large part of the people still put a lot of their money with all your traditional banks. And in fact, I think DBS Vickers for people that hold Singapore stocks, particularly so if you have multi-million-dollar portfolios, I think they will still feel more comfortable to put their money with DBS Vickers or OCBC securities compared to Tiger or Momo, for example. Not saying that they are not good or whatnot, but it's just a psychological thing. But I think other than that, in terms of innovation-wise, I think you can take a look across different geographies as well. There are a lot of disruptions happening, a lot of fintech up and rising. But I think looking at the landscape for now, firstly, I think Singapore is a highly regulated space, not that easy. Secondly, I think all the banks are also not sitting ducks. They're not like lame ducks. They're also doing a lot. And I think DBS was like, they won the World Digital Bank like title for quite some years. And in fact, I think OCBC also, I was thoroughly impressed as a consumer that time when I didn't need a card to withdraw money, even though there's a limit, so like a $1,000 limit, but you can use your phone like QR code to withdraw money without having physical card. So I think they're really not like a traditional bank just sitting there waiting to be disrupted. That's just my perspective. But back to the question on whether they have an economic moat other than brand equity, I'm not too sure. It does seem like increasingly there's less and lesser loyalty. That's my worry, at least for to get the NIM, the net interest to get the net interest margin and income, they need a huge capital base. So they need to keep attracting people. And like what Kelvin shared just now, as long as your competitor just increase their rates, everybody will just start moving their money away, which kind of hurts. But that being said, I think DBS being the biggest, largest, most recognizable, their base is still very, very strong, and people still keep parking their money with them. So that's why they are still. I don't see them being disrupted in the near term, at least. Very windy, long-winded answer, but yeah.
I'll just give a bit of example. For DBS, they added this whole crypto exchange thing. I believe most banks haven't even reached that part yet. So this at least quite innovative. At least they are trying to keep up with the times. Then for OCBC, they added this AI thing. It's quite limited, right? Right now, it's just like to give financial tips, not advice, financial tips. I guess it's a bit like ChatGPT. Then for UOB, they are investing in their innovation hub or something like that. So going forward, I do think they will still follow, especially for DBS. They have this guy called New Cross, I guess. New Cross. So he will be the one powering DBS innovation. And like what Chicken said, there won't be sitting ducks. So as in all of them know that they have to innovate. Otherwise, all these digital banks will start taking over them.
Yeah, I think let me just quickly comment my viewpoint on this. I think for comparing like banks, right, I do think that we should split up the two different segments. So their core business, right, I would say the main one is actually their lending business. So whether you're buying cars or you're buying houses, right? So you take up a mortgage. This one is really like their core business, because you can have all these, like digital banks that coming out. You are not going to take mortgage from all these digital banks, at least for now. So you take a mortgage, like you're paying all this, interest that you're paying, they get a margin out of it. I think this is like strong core business that is not going away soon. So it will be like this for probably for another at least 10 years or even much longer. So this is first one. Then the second one is all their wealth advisory business. So, like if you go to the banks, right, someone will come and talk to you, hey, you want to buy this product or not? So these are actually quite a high margin product that the banks have. Just because they maintain all these physical branches, it's not like they do it for free. Actually, it's the sales officers, right? So you just walk in there, they can come and sell you something. They get a cut from all those commissions. So my sense is that among these two, right, mortgage one or the lending business, I think they are fine. But on the wealth advisory arms, right, which is the high profit margin business, right, there might be more and more disruption coming. Just the difference is not like saying they are not innovative. It's just that how all these sales are done, right, is like we are moving closer and closer to all these like tech solutions. Like for example, now let's say if you want to invest, some people will come and sell you structured products, right? When you are going to banks. But I think in the future, people will just say, okay, you want to buy something, you just log into your apps, and then from the apps, you have a AI chatbot that can facilitate all these transactions, right? So I think it will take up a larger shares of all these high margin business. And robo-advisor is another example that people, instead of like going to banks or talking to the banks brokerage, right? Now they can just use, all these new like digital solutions that is more seamless. I'm not saying that the banks are, like will be disrupted because they are also fighting for the same pie, right? But at least there will be more competition in this field. That's my point on the questions that we just discussed. Going back to Kelvin, you want to ask something?
Before that, you're talking about the sales side, right?
Yep.
Then the banks would also be doing it on their own, right? So wouldn't it mean that you'll become even higher margin if they can remove the middleman or the people that are going out selling the products? Let's say in-house, you go into the UOB or DBS app, and then you ask a few questions, they prompt you, do a comprehensive financial analysis, and then say that ABC is good. Then you just buy straight from the app. Isn't that even higher margin?
Actually, when you talk about like facilitating all these sales, right, without the physical branch, without the people in between, right, we're talking about like digital kind of selling all these products, right? Banks can do that. All the like digital apps that can do that. Everyone can do that. It's just that the how the game is played is different compared to like having a human in between. So that's why I say there's more competitions. Not saying that the banks are losing out. Yeah.
So for Bunti, just now you pointed out that the wealth management part will be the, I guess, the growth part, not growth part, the one that will give higher returns. That was also what the analysts mentioned in the report. So because like when the Fed, right now we are very near the peak rate already. There's no way they are going to raise it any higher, hopefully. So that means that all this growth from DBS, UOB, OCBC, you won't see this kind of crazy growth anymore. This is the DBS net income. You can see that for around 2020, the net income is like, prior to that, it was just like flat. Okay, they got increase, but after that, the increase was quite crazy. So this is during the high interest rate time where all the interest rate was going up. So they were earning a lot of money from that. But going forward, from 2024 onwards, it was predicted that the Fed will start lowering rates. This means their net profit, will start dropping already. So they have to rely on something else to earn money. In this case, it will be the wealth management part that will be powering them. I don't think it's not just the robot advisor alone. It's also the treasury part for the rich clients. So they'll be their catalyst going forward. Then the rest is the innovation part again.
Since we have been talking about REITs last week, and then now we're talking about banks, right? And then I think both these two asset class or sub asset class, they share one similarity is that they are paying dividends. So for banks, it's simple, right? They have all this core business, they have earnings. They don't do a lot of like capex also, right? So what they do is they pay out dividends. And looking at the dividend yield that Kelvin just shared, right? I think they are about the same as REITs. Maybe REITs is slightly higher now, relatively speaking. So my questions to two of you is that would you prefer banks or would you prefer REITs? And maybe you can comment this both from like a more like a short-term kind of outlook versus like a longer-term outlook.
For me, actually, I prefer banks, like in terms of innovation, in terms of innovation and growth. DBS, I feel like the banks have more room to grow because their growth is not dependent on how much money they have, how much capital they have, but rather on how much growth, how much innovation they can deliver. So I guess the more innovative they are, the more the money they will earn. But for REITs, right, they are limited by their, what's they called, the gearing ratio. So there's most of them are already like 30-something%, nearing 40. So they can't grow as fast as banks, but their dividends are a lot more stable as compared to banks because banks are more cyclical. It depends on the interest rate. Interest rate up, they'll earn more money. Interest rate down, by 2024, they will earn less money. So, but for REITs, it's a lot different, right? It's a bit like inverse relationship where the interest rate down, REITs will earn more.
I don't have a preference. I like the saying, I don't care what color is the cat, as long as the cat can catch mice. But I think to kind of signal or to answer the short-term perspective or expectations, I think both type of asset classes like banks and sorry, not both type of asset classes. They are the same asset class, both type of different industries. One very heavy factor that governs both is interest rate. So assuming or depending on your current perspective of where the interest rate is moving, if you are expecting the interest rate to actually go down in the near to medium term, REITs might be better because it might revert back to the mean, and it might be less taxing in terms of their new loans that gonna expire and then they have to renew and stuff like that. So that's one perspective. But on the second perspective, which is what Kelvin shared, if you look at it from a much longer runway, if you plot it against many of the other different industries, it does seem like banks are outperforming because they are engaging in many different activities to try to bump up their EPS. Because at the end of the day, every single business that you buy is just the bottom line earnings and dividends they bring back, and then you just discount a yield and then you get that share price. So I think in the short term, a lot of people are trying to position that, oh, maybe REITs are going to have a rebound because of interest rate going down. But a lot of the banks have already enjoyed this high interest rate environment. So some might be speculating that it might go back down again if analysts are right in terms of the earnings being down momentarily in the short term. So that's just that. For me, I don't really have any position in banks. I am starting a position in REITs. It can be a tactical. You can look at it because I'm speculating. I'm being tactical in my portfolio, but at least that's my view and how I look at the markets. But yeah, I'll pass the time back to Punti.
Yeah, to add on, to add on about the innovation part, right? I think a few months ago, I was invited to Google to share how did I grow my YouTube channel. And the people who were attending the talks are from banks and insurance companies. Not trying to boast. So it's like, I can tell that what they are trying to do is that they know that their social media presence is like they are trying to learn how to connect to the masses in terms of YouTube at least because it's Google. So because they know that their ads are very it's targeting the masses but people won't watch ads just to learn stuff or whatever. People watch ads because it's blasted right into their face. So now they are trying to learn how to connect to people on a personal level. So I guess that's their also next part on the social media side.
Has any like banks or insurance company CEO reach out to you, say want to do a collaboration with you, do an interview?
No, don't have.
I have no more questions. I pass back to Chicken. Any follow up?
Actually, I just wanted, it's a interesting perspective. So for people or investors that are actually interested in investing in banks, right? There are actually some other instruments out there, which are also stocks, that hold a great deal of their positions in banks as well, which gives you an opportunity to buy at cheaper, because many of these so-called holding companies are actually selling at a very discounted price because they can be trading at a price to book of like 0.6, 0.7, even though they mark to market their equity position in major banks. I mean, to just roughly say why price to book is like that, because there's a certain holdings discount that the market is discounting. So in terms of their equity portfolio, let's say they own 100 million shares, 100 million worth of shares, but then the market cap today of that particular holding company is trading at 70 million, for example. So that's why it's a price to book of 0.7. But the shares that they hold, they're all like your UOB, your OCBC, or your DBS. And then you know that they cannot play with the accounting. They need to own their shares, like SGX approve their accounting policies and whatnot. And more importantly, there is also another business that you're buying, essentially for air quotes free, because the main business is also generating profits and stuff. So there's also another way to gain exposure, but don't forget that the market is not stupid. So there's a reason why they discount, because there is a middleman managing the so-called equities portfolio. So people might be not trusting the ability of that fund manager or the person running the company in terms of disposing or allocating capital. So just a fun fact, I'm not going to give any names, but I think you could just do a quick Google. You can kind of find out some of these holding companies that hold local bank shares, and they're all trading at discounted valuation under a one price to book. So yeah, that's just another way, just sharing.
I'll just add one more point, right? Because since we are talking about banks, I think sometimes we overly focus on like just talking about banks, right? But if you just zoom up a little bit and look at this, actually banks is like a subset of what we call the finance, right? Financial industry, right? So or finance sectors, right? I think in finance sectors there are other parts that are, I think, innovating faster as compared to banks. I will give a couple of examples. Like we all know that let's say if you look at over the past, call it like 10 or 15 years until now, right? There's this trend that is known as like I'm butchered it. So there's this intermediations of the products. So what I mean by that is that instead of like, last time everything is packaged as like one product, right? You can package it as an insurance, ILP, or you can package it as a structured product. Everything is done. And customer, what they do is they just sign and then they buy that products. But now you can see that all these products, right, they are being, like chopped up, and then people will get the segment that they only want. One example is like ETF, because last time, if you want to invest in a diversified funds, right, I think you can either buy, ILP or go to mutual funds directly, right? So you have these middle persons. But nowadays, there are more and more people, instead, they want to go to, like funds like BlackRock or Vanguards, where you have so many choices to choose, right? Choose the one that fit your appetite, right? So I do see that this trend will continue, meaning that people will prefer to, take more control on their finances. So they choose whatever products that they want, instead of like just talking to the banks that face front facing it, right? So I think if this trend continue, I do see that this is like one form of like a disruptions also, but this is not like a new disruption. It has been ongoing for a number of years already. Yeah, I just think that this is worth sharing.
Yeah, hope you guys enjoyed the discussion. We'll see you in the next video. Goodbye.